How's everyone doing today? Thank you, Cole, for a fantastic induction. I am, in fact, Gerrit Hall with Curve Finance. It's our first time here at the Rare Evo event, so we've had a fantastic time, and thank you for everyone for joining. And he is correct, I am here to talk about the Very Stablecoin Genius Act, or why TradFi Stablecoins need DeFi Stablecoins. And what's absolutely great about doing research for this is I'm sure that everyone, no matter what particular cryptocurrency project you follow, I'm sure that you all have noticed something, which is that when you turn to your social media feeds, everyone happens to be an expert. So it was really, really easy to research this. And the Genius Act in particular has proven that everyone is a genius on this topic. So it was great. I just needed to load up my feed and read some threads and bookmark them. But then, as I was going through them, I realized that there's a lot of contradictory information. So maybe they're not actually geniuses. Throughout the course of this presentation, I'm going to talk a bit first about the Genius Act, contextualize it, and why it's so important. Then we're going to dive into the differences between traditional finance or centralized stablecoins and decentralized stablecoins. And if you are not, one of the nice things about Rare Evo is that a lot of the people here are very international. So I've talked to a lot of people, and a lot of people came in from overseas to attend this conference, which is great work to the conference organizers for doing that. And whenever I talk to people who are international, there's a lot of misconceptions about how the US political system works. So I'm going to start this by premising it in the fact that you might be crypto native, but maybe you don't know much about American politics. And can I say, if you don't know anything about American politics, I'm so envious. Can we trade places? It's so exhausting to keep up with everything that's going on in American politics for the past several decades. But if you want to think of it in terms of DAOs, essentially the way that the US political system operates is that there's three co-equal branches of government. We're going to ignore the judicial branch for now because it's not super relevant to the discussion. There's an executive branch, which is essentially a one-of-one multi-sig, or just like a hot wallet. It's able to go in and make as many random changes and transactions as it would like. But if you lose the private keys, everything can be absolutely undone by the next person. So a lot of the crypto policy you're seeing that's coming out of Washington, D.C., it can change very, very rapidly. And it might be overturned in the next few years. The legislative branch, on the other hand, it is more of a 269 of 535 multi-sig. And if you've ever had the privilege of working with a DAO on even just like a 2 of 5 or a 3 of 7 multi-sig, you'll know it's very, very tough to get a bunch of multi-signers for even basic transactions. So when you're running a country with hundreds of multi-signers needed to execute legislation, that's very sticky. That sticks around for a long time. The Genius Act is one such thing. The Genius Act passed Congress by a bipartisan fashion, and that is also an incredibly rare feat because today's political environment is basically each party trying to throw the other party into prison, and yet they managed to stop trying to throw each other into prison for long enough to come together and agree that they need to pass the Stablecoin Act. So the Stablecoin Act is a very, very big deal. It's going to be around for a long time. It can't just be overturned like an executive order. It'll have to be supplanted by a legislative act. And as a result, it's really worth reading up what's in the Genius Act. And I was trying to figure out why is it that Congress is able to come together on this. And the next chart tells this picture. This is a breakdown of stablecoins by their underlying currency they're denominated in. And if you look at this chart, you'll notice it looks like the entire pie. 99.8% of all stablecoins are denominated in USD. And this is a remarkable fact, because for the past decade or so that I've been following crypto, it wasn't that the United States was really pushing and trying to get the entire DeFi space to adopt the dollar. In fact, it was the complete opposite. The United States was actively trying to prevent anything going on related to crypto. This is why if you're an American citizen, you can't claim airdrops. You have to use a VPN to sign into a lot of sites because we're being geofenced and geoblocked. The United States has been incredibly hostile to cryptocurrency. So essentially for the past decade, the entire financial system of the entire planet has been completely revolutionized. And despite the US actively trying to stop it, the dollar still managed to end up as the base layer DNA of this kind of new financial internet that we're all building. It's an amazing gift for the United States. It could have gone so badly because this is just product market fit. This is the free market at will. Degens could have picked Bitcoin to denominate DeFi. They could have picked Ethereum. They could have picked Cardano. They could have picked any random asset that they created, but they decided they felt most comfortable denominating in USD. So this has happened. The other remarkable thing about stablecoins that pushed Congress to act on this is that there is also product market fit in terms of the broader market. So if you look at the chart of stablecoin adoption, it's pretty close to up only, at least relative to those of us who have been in the trenches. If you've been holding crypto assets for the past, since 2022 to maybe 2024, you probably saw your portfolio tank maybe 90%. And you can see, like, yes, there's like a little bit of drawdown in stablecoin TVL in that time, but it is pretty relatively minor. And then around 2024, it's been a bull market for stablecoins ever since. So I look at this chart and I basically see stablecoins have been up only since their inception. So stablecoins are huge. Stablecoins are not going anywhere, and they very strongly benefit the United States. So it's super important to come together and pass this Genius Act. This presentation is on the topic of the difference between TradFi, or centralized stablecoins, and DeFi stablecoins. So let's go ahead and dive into this just a little bit more to understand the playing field. This chart here is the total TVL of all stablecoins, or rather I should say the total market cap of all stablecoins. In green, I've shaded the various centralized stablecoins. So these are the stablecoins that are generally held dollar for dollar in a bank account. Generally have KYC built in, so if you take your stablecoin and try and purchase some gimbap at a North Korean food stand, you'll probably find your tokens frozen very quickly. And as you can see, looking at this chart, pretty much centralized stablecoins are also almost the entire pie. That largest wedge is Tether. They have about 60% of the stablecoin market, about 160 billion Tether. Second place is USDC. Between the two of them, they're already about 80–90% of the entire market. It's only when you get to the third, fourth, and fifth place that you start to get to any of the decentralized stablecoins. And what's funny about these is, as they've seen the trends in the market, they're also kind of pivoting to become a bit more like centralized stablecoins themselves. So in addition to having, they generally launched a decentralized stablecoin on chain, and then they realized that there's a lot of money to be made by taking that, putting it into T-bills, owning RWAs. So really all the top 10 stablecoins essentially are all centralized stablecoins. So you can look at this and basically say, why are we even talking about decentralized stablecoins? Haven't centralized stablecoins basically already taken the entire pie? Is there any point to even considering decentralized stablecoins? But in this talk, I'm going to posit something of a Hegelian dialectic. I'm going to suggest that the value of stablecoins becomes much bigger when you combine centralized and decentralized stablecoins. So to do this, I'm going to look at the different risk factors between the centralized and decentralized stablecoins. If you look at centralized stablecoins, we'll start by diving into this incident in 2023 where USDC sort of had a rough weekend. I don't know how many people here followed this, but I was offline touching grass, and I looked at my phone and I was like, why is everything in DeFi down by 10%? This is absolutely crazy. And what happened was there was some chaos in the traditional finance banking system. Looked like Silicon Valley Bank might not make it. There was a transaction that USDC needed to send between one bank and another, and banks don't work on weekends, so we were going to have to wait till Monday to find out. Now at the same time, DeFi doesn't close. AMMs are still quoting prices, so USDC just went down 90 cents. It touched 85 cents in some places. And side note, people always ask me, how do you make money in stable coins when they're just pegged to $1? And this is the weekend where I went ahead, as soon as I got back home, it already trickled back up to 94 cents. And I'm like, all right, I'm going to buy a lot of USDC because either this is going to repeg and I'll make 6%, or I'm going to be working at McDonald's anyway. So what does it matter? This is what a centralized stablecoin depegging can kind of look like, because generally speaking, the risk factors for a centralized stablecoin are very different from the risk factors of a decentralized stablecoin. Usually they have money in the banks, so if the banking system collapses or if the US collapses, you might be in trouble. But generally speaking, it wasn't that scary of an incident for me because I knew enough about USDC to know it's pretty good. And what the Genius Act is really trying to do is it's trying to actually enshrine and make centralized stablecoins an even safer bet. And this is to contrast this with a decentralized stablecoin depegging. And there's a lot of risk factors that can affect decentralized stablecoins. They don't have bank risks, But there's smart contract risks, which means that, for example, if your decentralized stablecoin is backed by, let's say I give Ethereum and I get some dollars out, if there's a smart contract bug, everything gets wired to North Korea, it's all gone, and you just lost all your money. There's no one you can go to get it back. So decentralized stablecoins, in addition to this, have just all sorts of rug risk. What if the founder is just trying to steal the money and has a secret backdoor? There's a lot that can go wrong with decentralized stablecoins. And this can be a problem, but this is also a feature, because one of the key fundamental facts about stablecoins in particular, and also crypto more generally, this is just fundamental law you can take home, is that risk and rewards are very highly correlated. When you look at yields on decentralized stablecoins or anything, the higher the risk, the higher the reward. It doesn't sound complicated. People always forget this. People will see hey, this new pool is launching and they're giving 20% APY. They don't stop to think, well, why is it 20% APY? Why is this higher than the 10% I get over here on the safer platform? And that's just the free market pricing of risk. The way that most decentralized stablecoins manage their yields basically illustrates why this is the process. Essentially what usually happens is people just dump a giant pile of money and then they aim a fire hose of emissions at it and they dare you to pick up that money. And one thing we see here in Vegas, of course, is people are always going to take a chance. So you'll see people going in, diluting that yield, grabbing that money out, until the marginal point where it's the trader is I'm not sure it's worth it to grab that next dollar, and that's where the APY kind of stabilizes. And this is what you see when you see yields. Essentially, it's just the free market rank ordering of the actual underlying risk. In most cases, there are exceptions. There are issues where maybe not enough emissions are going towards it, or maybe it's just been launched and the free market hasn't had time to equilibrate. But at equilibrium, essentially you can just run down the yields you see in DeFi and say, this is generally a proxy for risk. Contrasts very much with yield in traditional finance stablecoins, which is usually, if you're getting anything, it's usually some function of the fact that it's being held in T-bills underneath the hood. It's also a very core property of the Genius Act. So we mentioned that there's a fundamental rule, which is that risk and reward are very tightly coupled in cryptocurrency and basically all of finance. The second fundamental law is that yield is basically the best form of marketing in cryptocurrency. It kind of doesn't matter what you try and position your product to compete on. You could say oh, we're very composable, we have a lot of integrations, we have a cool UI, we have the best parties. It doesn't matter. If you advertise yield, it doesn't shoot that out on social media, and you're going to see a ton of people just come in and decide if they want to pick that money up. And you can really see where if you put these two laws together, why we have so many bubblenomics in crypto. Because you can all but guarantee that there is going to be people that are chasing high yields, and you can all but guarantee that the risk and the rewards are basically correlated. It's essentially a corollary that people are always going to keep trying to grab this, get greedier and greedier. You're going to see 30% APYs, 40%, 50%. Go through another bear market, and we see these cycles just play out in an extremely rapid time frame relative to the traditional finance markets. So you could actually argue that this is part of the genius of the Genius Act, in that they looked at this and they said, well, we don't want to undermine confidence in the dollar. We don't want to have these collapses in stable coins. And they conspired to try and make basically the Genius Act make centralized stable coins very, very safe. And if you saw the DeFi panel earlier, you got to see Sam Kazemian talking about the misconception that the Genius Act is actually prohibiting all yield. And they do a good job of limiting it. But let's talk about this for a second. If you take away yield from stablecoins, who's the big winner? It's Tether. As we saw earlier, Tether already has 60% of the market. They're absolutely in the catbird seat because they have about 160 billion tethers, mostly in the form of treasuries. They get about 3-5%, whatever they get off that, and that goes entirely to them. Tether does not give any yield away to the end user. And it's a fantastic business. It's probably the most profitable company on the entire planet per employee. And their success is one of the reasons we're seeing so many other companies jealous of this and trying to launch their own stable coins. It's going to be very tough to compete with Tether, though, because the reason they're able to get away with this is because they've been around for so long. They launched this back when basically launching a stablecoin was an extremely gray area. It was kind of this offshore thing. It was always FUDed. Do they have the reserves behind it, but they've survived. They've essentially grown into systemically important status. And because they are now so big and they've been around so long, there's millions of integrations that have been built with Tether throughout all of DeFi, all of cryptocurrency. In fact, they are in a position where, in general, other protocols and asset issuers are interested in paying and subsidizing a liquidity pool with Tether because Tether is so important to access that network, access their network effects, that they're willing to subsidize the cost of pairing with Tether. So Tether gets free liquidity across the entire system. It's going to be very, very tough to compete with that. But it's still very profitable to try. So the second place stablecoin you mentioned was USDC. They, of course, recovered from their depeg. Circle IPO'd just in June, and this here graph shows off the business of how to run a centralized stablecoin. It's a complex business. It can be very tough, but you can see they eke out about a 9% profit margin, which is pretty good when they've been able to grow to about 60 billion USDC. And that IPO also shows off just how frothy and excited the broader market is to try and find ways to speculate on the stablecoin narrative. Because as mentioned, you can wait for a depeg and try and buy that up. That's a little tough. You can try and earn yield on it, but that's slow and steady, and everyone wants their money today. But how do you profit quickly off that stablecoin narrative? The IPO was the first a way for retail, traditional finance investors to actually bet on the stablecoin narrative that they've heard some about. And that's probably the reason that the IPO was priced around 30 and quickly popped to 90. And then, of course, they probably saw that operating chart I just showed, and more recently it's kind of come down as people realize that it is a very, very tough business to be in. So before we move on, just want to close out this concept of USDC and Circle and clear up this misconception about how is it that the Genius Act prohibits yield. If that's the killer use case for crypto, doesn't that just kind of undermine anyone's ability to actually be able to compete with Tether? Because that's one thing that you could do to try and gain market share. You could take some of the T-bill yield and you can give it to people. And there is a very specific language in the Genius Act, which is explaining how a specific regulated, I forget the exact terminology, but how a specific regulated stablecoin within the purview of the Genius Act is not itself able to offer yield. But it doesn't prohibit partners from providing what they call things like rewards. So if you notice USDC, you could still take your USDC, put it in Coinbase, you can still earn something like 3-4%. I do it, it works great for me. And pretty recently on I think it was an investor call, Brian Armstrong, the CEO of Coinbase, was asked well, how are you doing this? Doesn't the Genius Act prohibit the ability to give out yield? And they basically, Brian Armstrong said, well, first of all, we're not the asset issuer. The Genius Act only prohibits the asset issuer from offering yield. Coinbase and Circle co-founded USDC, but in 2023, Coinbase basically stepped away. So they're no longer responsible for issuing it. So it's entirely kosher for Circle to issue the USDC and then pass that to Coinbase, and Coinbase can offer the yield as the partner. And they don't call it yield as the other thing, because yield actually has a specific definition. They call it rewards. So the Genius Act was very genius in the way it was written to actually allow for incentivization of stablecoins, because the people who understood it, they know that the US dollar is important. They know that some form of financial imperialism is sort of important for spreading US interests around the world. And essentially the way the Genius Act is constructed is to build this very specific provision where if you follow these rules, you get extra special protections. Your stablecoin is extremely safe. In fact, it's probably even safer, I was talking with Sam earlier, than if you have money in a bank account. You can only have like 250K insured. If your stablecoin provider goes insolvent, you actually, as a bankruptcy creditor, have claims above $250,000. My understanding, again, not a lawyer, you should not be taking legal advice from probably anyone at this conference. The point about yield, though, is that if the centralized stablecoin issuers are not themselves going to be in the business of giving out this yield, where should they be looking to give out the yield? And what's nice is that in DeFi, there's high risk, but there's high reward. So this is the crux of why I think that TradFi stablecoins and DeFi stablecoins can and should coexist. because DeFi stablecoins are very good at finding yield. There's crazy ones like the meme coin-backed stablecoins that might be offering 5,000%, but generally speaking, if we just look at the empirical evidence, all the big successful centralized stablecoins, the ones who have gained market share and didn't have the foresight to launch 10 years ago, maybe they launched 1 or 2 years ago, the way that they've been successful has been by leaning heavily into the DeFi stablecoins. So if you are yourself an asset issuer and you are looking to maybe get involved with the DeFi projects, I can quickly plug one project that I helped launch, which is the Open Stablecoin Index shown here. What this is built off the Reserve Protocol DTF, or Decentralized Token Folio. It's the analog of an on-chain ETF, but instead of maybe having an index of 50 stocks, this is an index of 10 open source stablecoin projects. It's a quarterly reweight, so you just buy the token, you hold on to it, and each quarter the governance holders decide which tokens belong in here. Any of these projects are really good. They're probably not offering 50%, but they're probably offering really good, and a lot of traditional finance players have found a lot of success partnering with it. And incidentally, getting back to that point about how does the casual investor profit off the stablecoin narrative, this also provides a way to profit off of this on the decentralized side. So this launched a couple months ago, launched at $1. As of this screenshot, I was trading at $1.78. You guys can do the math on that one. Other notable projects that have really found product market fit at this intersection of DeFi and TradFi. Maple Finance, they are making a very big bet that all these companies that are currently buying Bitcoin and putting them on their balance sheets, their CFOs are going to say, we'd like to earn yield on that. So they are working as on-chain asset managers to find yield for that Bitcoin. So it's this perfect intersection of TradFi and DeFi. And you can see the numbers speak for themselves. This project is growing very fast, quarter over quarter. They also incidentally have their own decentralized stablecoin, Syrup USDC, which is feeding into their plans because they see that TradFi stablecoins need DeFi stablecoins. On this front, it hasn't launched yet, but check out Yield Basis. They're also working on a way of removing impermanent loss from liquidity pools, which is going to redound to the benefit of potentially higher yields on Bitcoin. So they might be getting into the same space, targeting the same intersection of TradFi and DeFi. Of course, BlackRock is got things nailed on the traditional finance side. They probably are the most equipped entity on the entire planet to navigate the movement of funds from people's retirement portfolios into things. They've very quickly, the BUIDL fund that they launched has very quickly rocketed up the leaderboards. It's, I think it was like 5th place on that list of stablecoins I showed earlier, and they're growing very, very fast. The way that they are partnering with a third-party entity called Elixir to incentivize curve pools is probably a perfect case study if you are interested in yourself learning how they actually run this template of nailing the intersection of TradFi and DeFi. And finally, I've just got a couple minutes left, but because I spend a lot of time on Curve, but people who don't know a lot about this conference might not know a lot about Curve, just a quick explanation of what Curve is and what it does. Curve launched in 2020, essentially on the back of a stablecoin trading algorithm that was better than the existing AMM algorithms. And at the time, this is kind of used as a way of attacking Curve, because stablecoins weren't the hot thing back then. It's like, how on earth are you going to make money as just a stablecoin exchange? You're just going to be earning pennies on the dollar here. Essentially, the way that it works, I won't bore you with the technical details, but when you're trading crypto, you want a line like that green line, which moves very quickly as prices adjust. When you're trading stablecoins, though, it's generally $1 for $1, so it needs to be more of a flat line. So the innovation was to say, well, why don't we just make a curve that looks a lot more like the flat line, but if there's a depeg, then it can go wild at the edges. This has birthed a fantastic business. Curve has since launched crypto trading algorithms. Curve has launched its own decentralized stablecoin, Curve USD, which is a member of that Open Stablecoin Index basket. If you're interested in geeking out about stablecoins, if you're interested in learning more about how Curve as a platform can facilitate stablecoin trading, maybe you're interested in launching, or maybe your institution has just launched a stablecoin. Maybe you run an L2 or your own chain and you'd like to bring Curve trading onto it, or maybe you just would like more information about anything we talked about here in this presentation. If so, my name is Gerrit. You can find me on X, Curve Cap. You can go to curve.finance. Find me in any of the social channels there. Very easy to get in touch with. Other than that, I hope everyone enjoys your time at the Rare Evo event, and I will catch you all outside.
Enjoying Rare Evo? Then lock in your spot for next year right now. Rare Evo 2026 is already in the works, and it's going to be even bigger. More chains, more builders, more connections. Tickets are live. Go to rareevo.io/2026 to grab your early access pricing before it's gone. Don't wait. Be first. Be part of what's next. We'll see you at Rare Evo 2026.